Hello and welcome to Creasey's Markets Uncut podcast, your weekly insight into topics and issues that we have been discussing here at Creasey. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and I'm delighted to be joined by regular market commentator and head of fixed interest Richard Carter, and to welcome back Ollie Creasey, head of property research. Welcome, Richard and Ollie. So while last week was fairly quiet in terms of economic news and updates, it was certainly a fascinating one, and we witnessed a number of notable moves in global bond markets, the Chinese equity market, and also some commodity prices. And when Richard and I last spoke 3 weeks ago, the US Federal Reserve had just announced the eagerly anticipated first cut in interest rates with a fairly bold 50 basis point cut, and we seem to be on track for a further 75 basis point reduction by the end of the year. And the following week, we also had the Chinese government announce a stimulus package to help boost the economy. And in the run-up to the holiday period, the Chinese and Hong Kong equity markets reacted very positively to that. So, Richard, it was just a few weeks ago that the mood was fairly positive for investors, and on a number of different fronts. And bond prices have been rising, equity markets were performing well as concerns over hard economic landings eased. But when we spoke with Ollie last week in our podcast, there had already been a slight shift in sentiment, with expectations over the extent of further interest rate cuts being reined in. And this follows some better than expected US labour market data. He also discussed with Ollie that the key risk of further escalation in the Middle East crisis to financial global markets was the prospect of higher oil prices leading to inflationary pressures. Now, oil prices had actually been falling in recent months, but as we reached the first year anniversary of those initial attacks, we did see a fairly sharp rise in oil price last week, albeit from low levels. And he also commented that the Chinese equity market had risen so sharply the week before that we seem to have basically sort of moved from a bear market to a bull market overnight. But once the Chinese equity market reopened after that holiday period, we actually saw a sharp sell-off, and perhaps that might turn out to be one of the shortest ever bull markets. So as mentioned, last week was fairly quiet in terms of economic data, although we did have the US inflation report released, and that showed that the headline inflation in the US had fallen to 2.4%. So Richard, could you give us an overview and your take of the key events and those market moves over the past week or so? And with the expectations of more aggressive rate cuts in the US having already been shifted, did anything meaningful come out of that US inflation report that might alter that?
Yeah, I mean, I think you're right, Andrew. The sort of mood over the last 2 or 3 weeks hasn't been quite so positive. Clearly the big worry is the Middle East and what's going on with Iran and Israel and Hezbollah and all the rest of it. And we're still sort of stuck in this situation, waiting for a potential Israeli response against the latest round of Iran missile attacks, and clearly that's has dangers for not just Middle East and global security, but also potentially the oil price if Israel were to hit sort of energy sensitive places, sites in Iran. So that's definitely a concern, and we'll wait and see what happens. China is moving in the right direction. I think, I mean, the big sort of long-term concerns about the economy that aren't going to go away, but clearly the government seems to have got the message, and their latest round of announcements seem to have gone down pretty well, and there's a lot they can do potentially to help the property market. And then I guess lastly in the States, you're right, we've moved on from a situation where the market was expecting very aggressive interest rate cuts from the Fed. They did do the 50 a few weeks ago. They'll cut rates by 50, and there was hope that there would be another one, but doesn't look the case now. I mean, you mentioned the jobs numbers; they'd been pretty good. Last week's inflation numbers a bit mixed, but the core underlying sort of core inflation is still relatively sticky. So the market now expects at most really 225 basis point cuts by the Fed. So that's not quite as encouraging for investors, but overall, I think the US economy is still in a pretty good place.
Thank you, Richard. I think what this all highlights to me is how short-term market movements are very much driven by expectation and sentiment, even if the longer-term underlying fundamental picture seems to be on track. I guess in part that's what makes our job so interesting and rewarding in terms of helping clients navigate through uncertain times. And short-term fluctuation, of course, do throw up opportunities, and with gilt yields sort of having risen over the past week or so, it does put our short-term bond strategy back on the radar. So, Richard, we've talked a lot about the sort of international scene and events going on there, but just to bring the focus back to the UK domestic economy for a moment, we had the sort of GDP figures released last Thursday, and that report showed that UK GDP rose by 0.2% for August. Was that in keeping with your expectations, and does that have any bearing on the trajectory for the UK interest rates? We had perhaps been expecting a further rate cut in November. And perhaps just to finish off, is there anything of note that you'll be watching out for over the course of this week, whether in the UK or further afield?
Yeah, I mean, I think the UK, GDP numbers, they come out every month these days. We shouldn't get too focused on just one number. I think the big picture for the UK is, growth is positive. We sort of seem to have come out of a period of recession or anything like that, but it's pretty sluggish overall. And Labour clearly, they've got this investment conference this week. They've got the budget coming up. They're sort of desperate to get growth back into the economy, but it's really an open question of whether they'll be able to achieve it. I mean, certainly GDP data, economic growth numbers in sort of Europe are pretty sluggish, and again, which is why central banks will be cutting in the near future. I mean, the ECB should be cutting this week. Bank of England, as you mentioned, probably 1 to 2 more rate cuts to come before year end. So hopefully that will give the economy a bit of a fillip. I mean, otherwise, I would just say, there are a few things we're watching. I mean, there's always, economic numbers coming out and things like that. But I think the sort of big thing is, as I mentioned earlier, Middle East. What's going to happen with Iran and Israel? We've got the US election just round the corner. Again, everyone says it's too close to call. The latest betting odds have Trump slightly ahead, which depending on your politics, potentially is quite alarming. And then obviously, yes, we'll see what central banks do over the next few weeks, and of course, not to forget that the UK budget just round the corner. So yeah, a lot of events coming up.
Thank you, Richard. So I'm also delighted to welcome back Ollie Creasey, and this week he is joining us in his capacity as Head of Property Research. So Ollie, we heard that the UK economy grew slightly in August, and in part that was helped by a pickup in the construction industry. And while sort of property and construction perhaps doesn't feature as much as it used to in investment portfolios, it is still a core part of the economy. And we also had a number of listed commercial property companies report results in recent weeks as well. So we all know that there's been a huge amount of uncertainty across the property sector as we have moved from that post-COVID era, and what the longer-term implications are going to be, and particularly for office space. And even before COVID, high streets have been struggling amidst a structural change in shopping habits. And of course, on top of that, we've had spiraling interest rates over the past couple of years. So, Ollie, in many ways, the sector has faced what perhaps could be described as a perfect storm. Although perhaps with interest rates finally turning, some of those clouds might be lifting. Could you just give us a broad update on what has been happening throughout the sector in recent times, and perhaps let us know how those recent company results fared? Were they in keeping with your expectations?
Hi, Andrew. Yeah, thank you for the question. And you're absolutely right. The property sector has been in a perfect storm. Sounds about right, actually. I might steal that for some future presentations. That's a neat encapsulation of it. And I think the interest rate environment has been the key one. Clearly, property is an income-based investment, and having to deal with higher rates, it impacts property yields and pushes values lower. And it has done that. It has been quite a sharp and painful transition to the higher rate environment. And as you say, there's been other headwinds as well. The change in office use through COVID, moving to online shopping, and those sort of things have all taken their hit on various different subsectors of the commercial property market. I think, without getting too much into it, there's reasons to be a little bit more optimistic now than there have been in the past. We've seen, you're right to mention some of these company reports and results. The key factor that I would highlight is that actually, well, there's two things. First of all, property valuations appear to have reached a bottom, and we can see that both in the results, but also in the sort of more generic statistics that we get. I'm not going to make predictions for the next 10 years necessarily, but it's pretty clear that we've come through the falling property valuations, and those values have largely stabilized and may even start now be ticking up. And the other point is that for all that the values, both on paper and in transactions, have been changing quite sharply, property rent growth has continued to be on a steady upward trajectory. I mean, it's been one of the key beneficiaries in a way of high inflation figures. And while we've been dealing with higher yields, we're also dealing with higher rents. And what we've seen so far is that both property owners directly are benefiting from those, and also the companies that own property that we invest in are seeing their earnings grow as a result of that as well. So it's been as expected. But it's perhaps important to note that the worst seems to be over at this point.
So, Ollie, so you mentioned there that you're sort of more positive on the outlook for the sector that many perhaps have been for a little while. And is that just solely on the back of expectations that the interest rate cycle has finally started to turn, or sort of valuations? And secondly, the property sector, of course, is made up of a wide variety of subsectors. Is that sort of optimism sort of spread across the board, or are there certain subsectors that you are particularly positive about, or areas that you still have reservations over?
Yeah, that's a good question as well. So I think to come to your first one, first of all, I mean, you can go back to Richard perhaps for an interest rate forecast. I'm not your man on that one. But what I would say is, rather than me forecasting a sharp or indeed a gradual decline in interest rates, actually it feels as though that is somewhat incidental to the sort of the thesis for property investment at the moment. As I mentioned, we've got a very steady, fairly reliable income yield on property across the board, and we've also got rental growth, which is for the time being driving capital growth on top of that. It's quite easy to sort of forecast a sensibly positive return on an investment that starts today. Now, if interest rates were to start falling and property yields started traveling with them, then that would be the cherry on top, if you like. But it's not something that is central to my investment thesis. What I would say perhaps is that it feels as though further interest rate rises are largely out of the picture for the time being, at least. Now, please don't come back to me in 6 months if something terribly wrong happens, but that would be, I think that's a fairly consensus opinion at this point in time. Now, to answer the second question, where are we most optimistic? Where are we least optimistic? It's more or less optimistic actually across the board. Now, I'm trying to think of how best to sort of define the areas that we're most optimistic. And it's really looking still at playing into the structural trends that we see happening. You'll be aware that sort of some of our key conviction buy recommendations are in spaces like the industrial market. We've seen ample reason to continue to be positive on that, whether it's e-commerce, whether it's near-shoring of inventories and so on. There's, as I say, ample reason to be positive there. And another sector that I would really highlight would be the data center sector. I mean, it's clearly one that's had an enormous boost from the sort of advent of AI and a few other things as well. But it's one where we are not about to enter an era where we have less data in the future than we have today. It seems like quite a one-way bet, and the only question really is how fast and how far does it go. Now, if you want me to try and be a little bit less optimistic, which is perhaps my natural outlook anyway, we do still have a degree of caution around the office market. I'm actually relatively comfortable with the office market in principle, but I'm aware that it's far from settled. And there are high vacancies in cities like London and elsewhere. And getting into that market today is quite a brave call. But I don't think the office is dead. You and I still use our respective offices from time to time, and I think we will do in 10, 20 years' time as well. So the death of the office is over exaggerated, but it is still changing, and it hasn't yet settled down, as I said. Now, if you want something a little bit out of left field as a negative idea, I'm also promoting a little bit of caution around the student accommodation sector. It's one that's been very strong. It's been booming. It's been very strong rental growth, as you can imagine. And actually, in some ways, it's looking very positive. I'm just urging people to maybe have a little bit of caution there. I'm nervous about the sort of financial status both of universities and of the students that study within them. And you can put rent up 10% per annum if you like, but at some point something has to give in that market. We know that student loans aren't growing at that sort of rate, and we know that students are continuing to struggle slightly. So I'm just mindful that sector could see some interference at some point in the near term future, and it's perhaps one that, just while it looks very interesting, it maybe requires a slightly higher degree of caution and thoughtfulness around it. So I'll leave it there, I think, for the time being.
Ollie, Richard, thank you very much for your insights and comments today. And before we draw to a close, if any listeners have any questions that they would like to ask one of our analysts for our future podcast, you can put forward your question to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. So to stay up to date with our thoughts on markets and current issues, please visit our website at www.quotachieveit.com. Here you can also see more of what we're doing at Quote Achieve It, as well as sign up for upcoming events. And we do have a few webinars coming up covering the budget, US election, and AIM as well. You can also watch past webinars on demand and subscribe to our weekly comment newsletter. So we'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. So thanks again to our Head of Fixed Interest, Richard Carter, and Ollie Creasey, Head of Property Research, and to you all for listening.